Let's bring in Greg Ip. He's the chief economics commentator at the Wall Street Journal. It's great to see you, Greg.
Hi, Kelly.
So let's not make this political. Just give us your straight analysis. You think the economy warrants a half-point cut?
I think if you look at the level of interest rates, it does. I mean, let's step back a little bit from the state of the economy and just look at the level of rates. 5.25% to 5.5%. That's actually quite high. Now, a year ago, when the Fed pushed rates to that level, it was saying we got an inflation problem. We really don't want it to get stuck above 3 or 4% where it is now. And we are willing to cause a recession to do that. They were very clear about that. And if you looked at the forecasts they put out there, a recession was actually virtually implied in that. Fast forward a year, inflation has come down very, very quickly. All the forward-looking indicators suggest that they will be very close to 2% within 12 to 18 months. There is no need for a recession. The level of rates today is just simply too high. And so, in my opinion, they need to start getting it back to something that looks more appropriate for what's starting to look like a normal economy. And that means a normal interest rate. I think getting started with that process with a half a point makes a lot of sense. Would a quarter point be a disaster? No. But if you actually weigh both sides of the argument, I think the argument for half is stronger.
If you're going to go there eventually, why don't you go there now? I mean, because you're on a path that's going to take interest rates over the next 2 years down from, 5.25% to something in the mid threes, I would guess.
Look, there's always this trade-off between we know exactly what we want, we'll go there now, versus optionality. There's things we're not sure about, let's build some optionality into it. To me, a half point kind of splits the difference. All right, we're pretty sure that no matter what happens in the economy, we're going to want rates lower than they are today, 6 to 12 months from now. But there are things that could go wrong. Maybe inflation does turn out to be a little bit stickier. Maybe there's a huge surge in the stock market, and this, speculative fervor that pushes the economy higher. That means you still have the room to apply the brakes and not cut any longer. If you went the entire 75, 100, 150 today, you kind of lose that optionality. And the Fed doesn't like to reverse itself. You can have a debate about whether that's a good thing or a bad thing, but they don't.
And there's a kind of bias towards incrementalism at the Fed as a big institution, right?
There is, but then look at 2022, all right? After the first quarter point, they started going a half, three quarters. Why were they moving in those big moves? Because they said we are so far below where we ultimately need to be.
We're behind.
We're taking very few risks by moving rapidly and taking a lot of risks by dragging our feet. And I think the inverse is partially true today.
Greg, it's great to see you.
Thanks for having me.
Giving us a little curtain raiser. Greg Ip.